All right, hey everybody, welcome back to Liquid Lunch, powered by CryptoQuant, the leader in on-chain data analytics. And we are excited to be back after the halving. We all made it. Everybody made it. And so we're honored today to have our guest, Bob Burnett. Bob, that Hawaiian shirt is looking amazing. You one-upped us, and I'm a little jealous.
Well, thanks for having me, Garrett. I wanted to fit in today, so hopefully I
I
do.
love it. I love the spirit of that. And we also have our head of research, Julio Moreno. Julio, how are you today? How are you doing past halving event? Everything's good?
Hello. Yeah, everything fine. Thank you. Thank you, Bob, for being here to chat with us.
My pleasure.
Yeah, so we're excited to bring you guys some data from what's happening with the miners, what is happening with the fees, what is happening post-halving. As you know, every 4 years, right, the rewards get cut in half. And so it kind of it changes the market a little bit, right? It gets rid of the miners that are not able to successfully allocate resources properly. And so today we're going to go through some of the data in what's happening right after the halving, as we had, fee spike and the runes and all this other stuff going on. So I'm going to hand it over to Julio, and let's get going with this report and see what we have in store.
Yeah, wanted to put some charts here about mining metrics, network metrics after the halving, just to do a quick review of that as context. And so here we have like miner daily revenue, the total daily revenue in dollars. And you can see here, this is the day of the halving. So record high daily revenue for miners, a little bit above $100 million. And now we after the 2 days, we are now at around $50 million, right? So we had a spike in the at the halving day, and we gonna see why. But yeah, that's just something to put into context how it's gonna be, has been for miners, right? Revenue wise, so a big spike there. Everyone did a lot of revenue that day, different companies that we also track, but now are more about $50 million for daily revenues for miners. And of course, a lot of that has had to do with the fees, the total fees. This is total fees in Bitcoin terms, daily Bitcoin terms, and of course, again, the spike there in the halving day, more than 1,200 Bitcoin in fees that day. It has come down also, but we're still higher than pre-halving period. So yeah, that's what caused the revenue to spike, mostly of course the fees. Just to give you a context, in the halving block saw around 36 Bitcoin of fees, which is the largest. Wow. So the previous halving, the previous halving block in 2020, the fees were only like I remember like 0.6 Bitcoin, right? And so now we had 36 Bitcoin. So that gives you like the view of what happened that day.
Now, did you guys celebrate the halving? Julio, were you celebrating? Were you having cocktails? Were you giving high fives? Bob, how about you?
Yeah, I went to a halving party here in Naples. We had about 25 people, and we celebrated it. We had a pool, kind of like a Super Bowl pool, for the time of the halving, and my wife won actually, so that was fun.
I didn't know that they had those. I'm gonna have to do that next time.
Yeah, well, you got to remember it's 4 years now, so you got to make notes to remember, right?
Yeah, I was in Dallas, Texas, so we kind of we were at an event, and we all kind of shouted and yelled, and everybody thought we were crazy, and then it just kind of went away. So how about you, Julio? Did you guys party down in Mexico City?
I was actually on a Twitter space, so in that precise time. But after that, we went to a meetup. Yeah, awesome. It's in Monterrey City, and so yeah, there was some drinks involved.
Love it.
So yeah, moving on. So just to give you context, like this is the block reward for miners, looking at the block subsidy and the fees here. And of course, again, like fees that day were 75% of the total block rewards for miners, right? Also a fresh record high. And now we are around 35. But, just to give people context of what happened that day. So it was crazy for fees. Also hash price,
Well, and
which
then
is
can we just talk about that real quick? Like let's kind of maybe explain like what happened. I mean, the reason the fees were so high is because of the inscription crowd, the runes, right? The
yeah.
SRC20 stuff. So they're minting on op
Yeah,
return.
actually I had a, if you see this one, oh, I had a slide. Yeah. So yeah, exactly. So we can see this on chain in the type of addresses that are used to mint this type of runes. Runes are like tokens, like fungible tokens, right? So
Right.
it's a protocol to mint fungible tokens on the Bitcoin blockchain. And so there's a spike of this type of addresses that are used, taproot addresses typically. And you can see that spike in our on-chain data, which coincides with the fees also spiking. And this has been the case in all 2023 with the inscriptions, right? It has been like that in inscriptions, then BRC20 tokens, and then this runes protocol that was launched, exactly at the halving block. That was when it was launched, and so there was a lot of transactions on the mempool trying to mint this kind of tokens, right? So that's why we had that.
Yeah,
Here
and
we'll
so
see.
what happens
Yep.
is, people are trying to compete for block space, right, Bob? And they have to pay more if they want to get to the front of the line, and so
Yeah.
how are you guys seeing that?
Well, this is just a precursor. I will say I am not a fan of ordinals, inscriptions, ruins. I think they're bad, and we can go into that later if you want to. But what I will say is they offer us a glimpse of the future. And one of the things I hope people in the Bitcoin world are starting to come to grips with is that block space is a commodity, that it is absolutely scarce, just like Bitcoin is. We have, by the statistics, are just over 53,000 blocks per year. We have 4 million weight units per block, which is typically about 4,000 transactions, and that's it. So the world will compete for the approximately 200 million transactions annually on the network. And as demand increases, the reaction to that is nonlinear. And you see that here, that it doesn't take a great change in the demand when the scarcity is already there. Because, for instance, in 2023, essentially every block was full. Now, not every transaction had urgency to it, because that's the other kind of vector in the equation, is the demand for the block space and what's the urgency of the transaction. But we're already at full. So I think we're gonna get fuller, and we're also gonna see more urgency. And so these charts that you're talking about here, when I do my modeling for our business, fees are actually where the game is at. We know what the subsidy is. Price is certainly something that is a bit is a wild card as well. But I actually think the world has a better grasp of where price is going than it does as to where fees are going.
Yeah,
Awesome.
fees are more volatile, right? More difficult to predict, I guess. Yes, exactly. And you can see the same here in the hash price, which is a metric for estimating the average income of miners each time they hash, like an average, right? And you can see also the spike to almost 20 cents on the dollar per terahash. But now we're coming down again to pre-halving levels. And just the hash rate. I mean, I think Bob can give us more color here, like what's happening to the hash rate after the halving, or what's the expectations. Certainly, so far it hasn't like moved a lot, because I mean the fees are high, and we haven't just like about 3 days after the halving. But what do you see, Bob, like for hash rate in general?
I think it's going to take us about 6 weeks to really understand what the impact is. And my expectation, if price stays roughly where it is, and fees stay roughly where they're settling now, then I think we'll lose 5 to 7% of hash rate, but we almost be instantly come back in over. So we'll lose that over the 6 weeks, and then probably 6 weeks after that we'll have regained it. So it'll look like on the chart, it's going to just kind of look like a slight plateau.
It's
Yeah,
such a cool thing too, because it kind of like, it's kind of like it's self-cleansing system, right? If there are unprofitable miners, right? If there are miners that are not being productive with their resources, like it just, they just kind of basically go out of business at this point, right? So it's kind of
Yeah.
a self-cleansing system in that the most productive, well, it also makes you guys stay on your toes, I would imagine, Bob, right? You guys have to make sure, you guys are doing everything at the lowest cost to ensure you guys are being profitable at those levels.
Yeah, I mean, if you're in the mining business and you didn't prepare for the halving, then you probably shouldn't be in the mining business, right? So, we spent the last year, we basically every server in our operating umbrella was replaced within the last year. So, like as an example, I can say publicly, like, we have everything in our system. The lowest thing we have operating now would be an S19 J Pro Plus at 120 terahashes. That's the worst. And of course, we have up to S21 200s in there. So I think the real question on this hash rate is how long can those machines that were maybe in there's some S17s still around, can those still hang on? And the older S19s, especially the things that maybe are in that 90 to 110 terahash per second range, that really is the wild card, because
Right.
we really don't know. We really don't know how long they'll hang on and how much those are distributed against lower cost energy sites too.
Yeah. What happens to the older miners? Are they repurposed? Do they get sold? Do they get used for scrap? What typically happens with those older ones?
I'll say for me, I don't have a lot of optimism for them.
Okay.
They can become a parts pile. Some of the parts are usable, although not a ton. I'd say largely they become unusable. Now, I will say I'm working on a project. I don't have enough time to go into it, but I'm working on a project to use this equipment for non-Bitcoin purposes, using proof of work to do completely different things, basically to generate entropy or other reasons. And, we may ultimately find that market. And, I can talk to you about that a little later if you like.
Cool. Yeah, we'll get through some of the rest of these slides, but it's super interesting, with the hash rate, being, what it is, it's absolutely, still ripping, in the general sense. And so that's a good thing to see, because that protects everybody, right? That protects the network. So it's good to see.
Yeah, and some of the these equipment, people use it like in their homes, or I mean, I don't know how much is the total amount, right? But they use it for heating. There's some of those use cases, so they're not running it for exactly for like profit, right?
Yeah.
The S9s or the others, and so that's why I think like that's something that makes hash rate so resilient, right? Also, because there's all other, like you say, other purposes that can be used, older equipment. Yeah, just the last slide is a metric that we use to this metric, the hash coin that we call it. It's just estimate of how much hash rate you need to produce one Bitcoin per day. So, and it also like dramatically decrease on the halving day, because with the fees lowering that, but it's now coming back. So almost, I would say almost 1 exahash you need to generate one Bitcoin per day, right? So that gives us a just estimate of the cost to generate that Bitcoin in terms of hash rate. So yes, I think that are the slides that we wanted to show, and so I'll stop sharing.
Okay, cool. Yeah, I mean, at the current rate, we're mining, it's about 450 Bitcoins per day. And I think BlackRock is buying that much every day that's available. So yeah, we're going to see what's going to happen with the supply constraints as we go into, the rest of this year and see how that affects price and everything else. But no, guys, we're super excited to have Bob here today. Bob's been gracious enough to bless us with his presence and his amazing Hawaiian shirt, which, Bob, you got to tell us where you get those at. I mean, come on now.
Yeah.
A little jealous.
Well, like I said, I live in Naples, Florida, so this motif is very common in stores throughout the area. So everybody's got a couple.
I love it. And so if you guys are not familiar with Bob, he's got a very colorful past, especially being that of the CTO of Gateway Computers. And so, Gateway was a massive force back in the day. And do you want to tell us a little bit about your transition from maybe that tech industry to Bitcoin, like how you found Bitcoin? Your handle on Twitter is Boomer BTC, which I think is hilarious because you just kind of right, you emphasize go
Gotta
right into
embrace
that
it.
boom. And I have a problem orange pilling my boomer parents, right? Because they are still not understanding it. And so maybe give us a little bit about your transition from that tech to Bitcoin and how that took place.
It really starts with computer design, which is as you mentioned, that's where I came from. I designed laptops and desktops going back to the mid 80s. And I left that industry in 2004, but was still kind of I was running an angel incubator kind of fund. And in 2017, I got a phone call from an ex-Gateway person that said, "Hey, Bob, I have a group. We're trying to put up an 800 unit Ethereum server farm back when Ethereum was still proof of work, right? And we can't get them professionally. No, we can't find a professionally designed Ethereum mining server, number one. And number two, even if we could, nobody can get the NVIDIA chips, which at that point, it was all GPU based, right, stuff. So I was not really exposed to, at that point, the cryptocurrency area. I just looked at it as a computer guy. Said, well, can I design this kind of computer? Sure. We called NVIDIA. There's a long history of Gateway and NVIDIA going back to when they were a startup. And we called them. They remembered me and some of the members of my team. They said they would give us the chips. So we started a company to fulfill that order because it was about a $6 million order at that time. So nice order to start your company with, right? So we did that. And then we started, after we fulfilled that order, we started asking other people, would you like to buy one of these? And a lot of people said yes, but most of the people that said yes said, only if you'll host it for me. So that took us from designing the computers to hosting the computers. We were making a lot of money, so we started taking the profits into our own mining equipment. That kind of talks about maybe a 4 or 5 month window. Then I started digging deeper into the technology of Ethereum, monetary policy of Ethereum. I have a background in economics too, and I didn't like what I saw. It did not appeal to me, and from several different vectors. I started looking seriously at what Ethereum or what Bitcoin offered. I loved what it had to offer, and so we pivoted the company away from Ethereum to Bitcoin, and here we are today. And now what we do is we specialize in small to medium sized mining sites. I don't believe in building big sites. There's a number of reasons why. The public mining companies kind of fill that role. But I think it's a bit misguided, and I think there are issues with it, which we can talk about later if you'd like.
Yeah, and for those that don't know, Bob is the CEO of Barefoot Mining, and this is such a cool concept, you guys, because what they do is they literally go out and find pockets of energy that have not been utilized or accessed for a long time. And so you can go into very rural areas, right? Tap into energy and then use that to basically not only fire up a local economy, say in a very rural part of some country, but you're accessing tapping into energy that can then basically run these machines at almost like zero cost to some degree. Is that kind of correct?
Well, I would say at least at a competitive cost. I mean, it depends if it's on grid or off grid and, those sort of things. But yeah, and we like doing that for several reasons. One is we can usually do it quickly. So one of the things, if you deploy capital into mining, my belief is, hey, you want to deploy that capital and start getting a return on that investment as fast as possible. Because the best day to mine is today, the next best is tomorrow. So if you do a big project, let's say you're going to spend $100 million to do a 100 megawatt project, and it's going to take you 15 months. Well, you're going to start deploying a lot of money well before you start seeing any cash flow back. And we just went through a bunch of charts. Well, Bitcoin's highly volatile. It's run in cycles. You don't know when the bull starts, when the bull ends, when the bear starts, when the bear ends. And when you're going out 15 months in time, you're often going into a completely different cycle than the one that you started the project with.
Well, plus you lost that 15 months of that lower hash power that you could have had before the
right.
halving, right?
So, what I'd say is, well, if given the choice of building, we'll just say 52 megawatt sites or one 100 megawatt site, I'll do the 52 megawatt sites. One, I'm going to have a whole bunch of hash that will have been running before the 100 megawatt site gets up. If the market conditions change, I can stop and pause for those conditions to improve or back in my favor. Because there's something called the miner's trilemma, which we can talk about before, that shifts. I also get diversity. So I now don't have my operation dependent on one power generation source. I'm not in one legal jurisdiction where things could get banned or a tax could get implemented or something like that. So that's why I do it that way. The reason the big guys would say, Bob, you're nuts, is they would say, well, you're not very efficient. You've spread your resources out. They might argue that they can do it on a lower energy cost too. I would probably challenge that, but that's what I think they would typically say. We have a variety of different energy costs that we produce from, and some it depends on if we're producing the energy ourselves or if we're buying it on the grid. But if we're buying it on the grid, like you said, we can find these little pockets sometimes where there's a small rural electric company, let's say, and maybe the whole rural cooperative only has 40 megawatts. Okay. But they're going to operate cheaper if they consume 40, if they can consume close to their max. And if they have a substation that has 2 megawatts unutilized, and we can step in and say, we'll take that 2 megawatts, that's really appealing to them. And it actually helps everybody in the cooperative because now their cost of energy is going to go down. So anyway, we call those horse class sites, by the way. I call the big ones elephants. And then Julio talked about the plebs. Actually, he was talking about like the people with the heaters and the hot tubs and all those sort of things. Those are the plebs out there. And for me, the long-term stability and integrity of the Bitcoin network is dependent on the horses and the plebs, what I call the rabbits, being there. We need that to create that, because if we become all elephants someday, that's a real problem.
It's a risk, right, of centralization, right, of
Yeah.
censorship, perhaps government
Yeah,
interference, and so we need the decentralization of the miners, which is absolutely key. So we definitely appreciate what you're doing, and we think that's very important to the ecosystem.
yeah, thank you.
Yeah, yeah, Bob, can you just for the audience like explain like that classification that you have made for miners? I mean, I found it really interesting in an article that I
Sure,
read.
sure. Okay, so there's first there's kind of site sizes. So the elephants are probably they're big sites, 50 megawatts, 100 megawatts, 200 megawatts. There's a tremendous amount of concentration of power and hash in one spot. Those are the elephants. And I call them elephants because they're big and powerful, but they're also slow to develop, slow to grow, and they're also easy to hunt. The rabbits are on the other end of the spectrum. Those are individuals typically, or maybe a real small business. They have one machine, two machines, three machines. Individually, they're not very powerful at all. Collectively, they can be very important and very powerful, though. They're also difficult to hunt because the minute you start hunting for rabbits, they can scatter. They can turn off, they can move, they can go all these different places. So if your goal is to exterminate the rabbits, you'll never get there, right? If you're a government and you're saying, I'm going to go hunt the rabbits, good luck, you'll never make it. But you could hunt all the elephants pretty easily, right? The horses sit in the middle ground. They're small to medium sized commercial operations. For me, that could be, let's say, a 400 kilowatt site up to maybe 5, maybe 10 at the upper extreme of a horse site. They're almost always built in a mobile capacity. They're containerized. You can pick up and move them quickly. We can develop them pretty quickly. They're pretty powerful. If you start hunting them, you'll get more than the rabbits, but you're still going to have basically the same problem. That if we are notified that, hey, there's an initiative to go start hunting horses, we can hide pretty quickly. Now there's a second vector on that. So any of those could either be what I call captive or wild. So wild, for the most part, those terms refer to whether or not you're on grid or off grid, although that's not completely true. So most of the elephant sites, almost all the elephant sites are captive elephants. So they're captive because they're on grid. That's really typically the only way to get that level of power. But they're also captive by being typically a public company, that puts you under the auspices of the SEC and auditors and regulators and all these sorts of things. And it creates certain types of behaviors and certain restrictions. Wild typically would mean you're privately held and you're generating your own energy. For instance, we own a hydroelectric dam in South Carolina. So we aren't connected to the grid at all. We generate for that site all the power on our own.
That's pretty awesome, and I love that concept of I mean, we are kind of in this battle with the centralized authorities, and so you are making a business that's adaptable to possibly thumbing your nose at them to some degree.
Yeah.
And
Yeah.
I mean, let's be honest, right? Like, this administration has not been very friendly to Bitcoin miners, and they actually reintroduced, right, the mining tax as part of the budget
Yep.
proposal. And so,
Right.
what does that look like? How are you guys, positioning yourself for those types of scenarios?
Great question. Well, two ways. Well, first is, I mean, inherently our strategy is to try to be as indescript as possible. If it was declared illegal or something like that, that creates a problem. But by generating our own power, that creates another level of insulation from that. Now, they could still try to tax it. In fact, this budget proposal does still even try to tax your own power generation. Folks, if you're listening to that, think about that insanity. That literally they would say, if you want to take it to extreme, if I hooked up an exercise bike to a generator, and I powered an S19 for an hour, like sweat my ass off riding on the bike. The new Biden proposal would say the energy that was produced should be taxed. That's how insane that bill is. So, but we still, I think, provide some insulation from that. But the second thing, interestingly, I alluded to this before, is when the first Biden proposal in this time last year, when the 2024 budget was being proposed, they tried the same thing. And it created the impetus for me to start implementing an idea that I'd had in the back of my head for a few years, which is, hey, we should not think of a product like an S19 or a WhatsMiner product as a Bitcoin mining system. They are entropy generators. Now, we utilize that as the proof of work mechanism for Bitcoin, but we don't have to. There are other things we could do with it. So you'll soon see, literally in a couple of weeks, you're going to see an announcement from me about a couple different websites where I use products like S19s to generate things like random numbers. So you'll be able to go to the website, for instance, and shuffle a deck of cards, flip a coin, sequence a random sequence of numbers between 1 and 1,000. You'll be able to do those sort of things. And what's generating that is an S19. Now, I actually believe there's a legitimate business there. The world of random numbers is actually a market, and there are lots of everything from scientific research and pharmaceutical modeling and Monte Carlo analysis and cryptography, and there's actually a wide range of things. And I believe we can create random numbers. We can do it in an auditable and verifiable way, though. So there are sources of random numbers out there, but there's never been a way of creating them in an auditable and verifiable way. So what we're doing is we're redeploying some of the basic technology that was created with Bitcoin and the proof of work mechanisms and applying them to random numbers. So what that does, though, and the reason I took you down that path, is it gets very difficult for regulatory authority to look at a given piece of equipment and say that it now should be taxed a certain way, because in reality, it's no different than your personal computer. It's a general purpose device that has lots of applications. Right. And I believe it's completely immoral for a government to take on for governments to look at energy consumption and make a moral judgment about which one is which is better than the other. To say, hey, your microwave oven is more just than your hot tub. That's more just than Christmas lights. That's, more just than somebody watching pornography on a computer. Like, right. Taken to the extreme, you start seeing government authorities taxing in these ways.
Right. And it's also ridiculous because the service you are providing is actually a net benefit to the grid, right? Like if you go into these small rural towns and tap into that energy and you provide that stability to their grid, you guys can instantly shut off to provide extra power to the local community if they have an emergency, right? And so it's all these other things. I think we need to switch that conversation. Be like, you guys are missing the entire point of this energy production, right? Like we are actually a net benefit to the entire grid itself.
Yeah. And what we fight as I think everybody knows, there's no CEO of Bitcoin. We don't have a government relations department. When I was at Gateway, we had those sort of things. We had a government relations group that was based in DC, and they were lobbyists, right? They they were there. Now, we do have organizations like the Digital Chamber, Satoshi Action Fund, but yeah, I mean, so we have pieces though that kind of are there, but we don't have this collective, and that's used against us. And it's, by the way, it's not just a US issue, it's a global issue. About a week ago, I had to write a 20-page testimonial to the European Commission because they're trying to ban proof of work across all of Europe. They've already done such a good job in Europe of making miners not welcome that there's very little activity there. To me, it's very sad, and it ultimately will lead to some huge economic and political disadvantage to all the European countries. And they're on the cusp of falling way behind. And this is an opportunity for people in Central America, in South America, in Africa, in the Middle East, in Southeast Asia to take maybe a second or third world economy and make it enormous. So we have like Bhutan is, making huge investments. I think they're very, very smart to have taken that initiative.
Just a question, to go a little bit deeper on that, because we're starting to talk about geography, right? How do you see like this new cycle that started with the halving, the mining geography evolving, right? Because the US has taken the lead, right, from in the previous cycle, right? But now we see the government putting some regulations and maybe taxes, and so how do you think it can evolve, the next cycle?
Well, there's that factor, Julio, but the second factor in the US is that there's now massive competition from AI, high performance computing, and EVs. So about a year ago, I had done a study. I looked at US Department of Energy statistics on how much energy was already planned to be added, and power generation, right? And then you cross-check that against, for instance, just the lower bound of the EVs, and how much energy we're going to have to add to the grid just to charge the low end of the car range. And they're about the same number, by the way, meaning there isn't much of an energy surplus over the rest of the decade in the United States. And then on top of that, kind of coming out of nowhere, the AI cycle or the AI expansion is causing a lot of demand. And we are seeing that already. We are seeing across the US, any major power source, the AI folks are coming in, and they're often outbidding, by the way, the miners. They'll pay a higher price. I mean, right now their market on a per joule or per watt basis, you can make more money with AI than you can with mining, and often in a more stable way. So you've seen some of the big public mining companies have kind of added some of that into the vector because of that. So the answer to your question was, I think we're going to see growth in the U.S., but at a declining rate, and we're going to see other markets. We'll use something like, let's say Ethiopia. Okay, Ethiopia has a lot of power. We don't have anything there today. We've talked to people there several times and are continuing to talk there. And I would say there's a decent shot in the next year or two we have some assets there. But I don't think you're going to see many high performance computing or AI folks want to go there. They won't have the risk appetite for that kind of market, where we and I think the mining industry will. So I think that's going to help some of these international markets grow, and that's very good for Bitcoin, right? Because I think we are we are on the verge of being too concentrated in the US and being exposed to the same problem we had with the China mining ban in 2021, where if something extreme were to happen and mining was banned in the US, we'd have a big disruption in the
So
mining.
when Max Kaiser says this is really a battle between Bitcoin and AI, I mean, this is really coming to the forefront. He is not joking when it comes to that, as you're seeing on the front lines there, Bob, which is unique. I had not heard that before. So very, very interesting. Guys, real quick, just want to mention in case you guys came in late, we're at Liquid Lunch powered by CryptoQuant, where we're actually offering a special halving promotion up to 50% off of our professional plan. So if you do not have an account at CryptoQuant.com, go ahead and check it out. Go ahead and get a free account. And we do have this special offer up until May 4th, and there is a limited number of those deals available. So go ahead and check that out when you get a chance. And so, Bob, let's bring it back to some of the data, right? Because we're a data company. Obviously, we love data. We eat, breathe, swim in data every day. And what is your guys's kind of strategy, if you can devolve any of it at Barefoot? Are you guys kind of hodlers? Do you guys have quants that try to time some ups and downs? Obviously you have to generate, income for the business and pay bills and stuff. So we understand that's part of it. What does that look like internally with you guys?
Yeah, so we don't HODL a lot, but we're a Bitcoin-based company, so we're not converting to cash other than bare expenses. So the way this plays out, though, is each of the sites we bring up is a unique LLC. So Barefoot Mining is an umbrella company that operates and owns parts of all of these sites, but we also have private investors that come in on each of the remote sites. Okay. And so what we do is we distribute the free cash flow in Bitcoin every month. So like we're, 2 weeks ago when we wrapped up April, we said, okay, let's say on a given site, okay, if we had a Bitcoin of free cash flow, we took that Bitcoin based on the percentage ownership and we sent it out to everybody. So I don't believe in companies hodling in our space. I think it's fine for like a MicroStrategy to hodl as a treasury strategy, but I really don't think it's wise to have massive amounts of Bitcoin that's hodled. I mean, I believe you should get it out to your investors. In terms of how we sell, we don't have a lot of sophistication there, but we have some reserve money, so we have some fiat in reserve. If we're at a point in time where it's not advantageous to sell, we have some reserves that we can draw off of to buy some time to defer the sales to cover operating expenses. As we're getting bigger, I think we're getting to the point where we'll probably start using some derivatives a little more, especially in the longer term. So when we're bringing up a site, we typically look at the servers within that site as having a 4-year cycle and the infrastructure having maybe a 12 to 15-year cycle. So what we're looking at is we're saying, hey, the new site's coming up. Let's say it's going to come up on July 1st. We're gonna 2024. We're gonna assume we're gonna run that the base servers until 2028. So we have a model that we've developed that's looking at price, at global hash rate, and fees. Those are the 3 key variables to try to project what range this investment might provide to investors. But now what I'm starting to do is, look at trying to use some of the derivative products to moderate and stabilize some of that. Part of that comes from, I mentioned it before, and it goes back to your charts. What's happening right now is, in Bitcoin terms, the business is getting more volatile. So, historically, we've seen 3-5% of revenue be fees for miners, and the balance be subsidy. Well, my prediction is that as we exit this epoch by 4 years from now, we will be at parity, meaning 50% fees and 50% subsidy. And then as we go into the next one, it could exceed that. But fees are much more, especially in Bitcoin terms, they're highly variable. And so we're going to look at finding stability, especially in that section.
Awesome. Awesome. And so, and we love that because you guys are such a great, asset to the community. And so we understand that you have to sell some, and we understand all that. So, but overall, the net benefit is obviously there. So, next question I kind of wanted to get into is like, we always get this energy FUD, right? Oh, it uses too much energy and blah, blah, blah. And you guys are, obviously using sustainable energy. As you know, Elon Musk, right, stopped taking Bitcoin payments for Teslas because he believed the energy consumption was not sustainable. And I know you're tapping into a lot of sustainable energy sources. Where do you have an estimate of what you think, like is actually being used for energy as sustainable versus, non-sustainable energies in this context?
For us, yes. We're at about 75%.
Oh wow. That's
Slightly
pretty
up ahead of the industry norm. And it's slowly increasing.
We're gonna have to get
I
you to educate Elon Musk on what you guys are doing, on how sustainable you guys are doing that. So
yeah, well, like I said, the problem is, I mean, the data is out there. I'm happy to share that piece of our data set for Barefoot with the world. The Bitcoin Mining Council produces data. There's other data sources, even like Cambridge and some quote unquote independent sources, put it as the most sustainable industry in the world, but it doesn't fit the narrative. And so like I mentioned, this European Commission group that is fighting proof of work in Europe. And they still are pulling data from like Digiconomist and Alex DeVries, for those of you who aren't familiar. And they'll project energy consumption using 2-year-old technology. So as you guys probably know, hash rate growth and energy consumption growth are two completely different things. It fundamentally comes down to Moore's law, which is that we can get per watt of energy we consume, we're getting a whole lot more hash today than we did 2 years ago.
Right.
And so we're not seeing this exponential growth in Bitcoin energy consumption, number one, even at the top line. And then number two, we seek sources of energy we can control. Those tend to be sustainable, by the way. We also seek lowest cost of energy, and it's usually in places where sustainable energy is being produced that aligns. So yeah, I think all the information is there, but we'll go back to we don't have a great PR engine today. We don't have a marketing department, and that's part of our problem.
Yeah, I just want to ask Bob if he has some estimate of the production costs for Bitcoin for the network as an average. Like, what's the cost to produce one Bitcoin in dollar terms? Because I've seen some estimates that after the halving, the production cost increased to $77,000 per Bitcoin. So how do you see, of course it depends on your energy price, right? And your equipment and all that. So what's your insight there?
Well, I typically don't look at it that way, but we could extrapolate it quickly. I think the network is consuming about 160 terawatt hours annualized right now, to produce just over 600 exahashes. And if you use 5% energy, and you also assume about 30% of operating costs are energy, Boy, I hope I did this right in my head because I'm trying to do a lot in my head at the same time. I think that would put us more like in the mid to high 40s. So I
Um,
tried, there was a lot of math in my head at one time, so I may have, but no,
Another question.
the industry is profitable. I mean, I think you guys cover some of the public miners and some of that. I think the interesting thing about the public miners is that they really don't represent the industry as a whole. I mean, they operate very differently than the private sector, the privately held ones. Um, their business model historically has been to see market cap appreciation based on hash rate. And so, they'll offer shares to the marketplace to acquire hash rate, and then the market will respond with an increase in market cap greater than the cost of acquiring the equipment. But they, for the most part, I don't want to be too critical of any one company right now. They typically have very high overheads, so, you know,
Yeah.
but when you ask even a cost of production, if there are large executive bonuses, if, how are the options, stock options, are they dilutive? There's a lot of those sort of questions that come into the equation. But I would say this, at current levels, the industry is healthy as long as there's not some extraneous overhead driving an individual company into unprofitability. But I will say this one other thing. This year has been phenomenal. So as the public miners announce their Q1 results, I would say, unsolicited advice, be very careful if somebody wasn't profitable, because
Yeah.
if you didn't make money, a significant amount of money in the first quarter, I'm not sure how you're going to make money in the coming few years.
Yeah, good point. That's a good point. Now, another thing you are involved in is the ocean mining pool. Okay, so this is, I switched my miners over to Ocean as soon as they came on board. I think it's such an amazing
Thank you.
endeavor. And is Barefoot primarily using the Ocean pool for, the ones that they're directing their hash power to? Do you guys use multiple ones? What does that look like, from a miner's perspective on what pool to choose when they want to start, earning?
Yeah, first of all, thank you for your support, personally. Um, yes, we primarily use Ocean.
Okay.
We don't exclusively use Ocean. Now, the primary reason we don't exclusively use Ocean is that we maintain at least a decent enough hash with several other pools to always be measuring whether or not Ocean is performing,
Mm,
because I have a responsibility to my investors. I have to show them that, just because I own part of Ocean, I can't, I have to justify that we use them to my investors, right? So that's important. I want to keep the other guys honest. I want to see how they're performing. By the way, it's very interesting that they're not identical. They all use the same payout method, which is FPPS, but they don't provide identical results. And for those of you who are miners, I think that should be a very interesting question you should ask yourself as to why they don't produce identical results. They should.
yeah, I love the sovereignty it brings and everything else. But let's get into maybe some fiat, some prices. What do we think is going to happen with the price, Bob? Are you expecting 100K before the end of the year? What do you think? Where do you think this is going?
I would say that's the most likely scenario. I always try to deal more in ranges, and so I think we will still see another all-time worst case. I still think we see another all-time high this year, and that might be 80. That's kind of my worst case. Um, and my best case probably gets into the $140,000 range. That's where I
By the end of
think
the
the
year?
top is by the end of the year. Yeah.
For this cycle, I think it's around 140, 150. Yeah,
Yeah.
based on some network metrics that we follow. Yep, definitely.
Yeah, look, I mean, we've got a lot of different things going on. We've got BRICS nations coming on board. We've got, they've just agreed to use a crypto stablecoin possibly to settle disputes, right? They're getting off of the dollar. The treasury market is having some abysmal auctions lately. So, you know, this could go a lot higher.
Yeah. Well, I think the action last week of giving all the Russian assets to the Ukrainians is,
Yeah,
you know,
ridiculous.
I think regardless of where anybody sits politically, and I had the opportunity to work a tiny bit with the El Salvadorian government when they were working on their legal tender status. And there's no doubt that if you are a leader of a country like El Salvador and you see essentially the US Western financial system decide using money as a weapon and assigning the assets of one nation to another nation, you got to ask yourself your question, even if you're in have a good relationship with the US and Europe now, whether or not you will continue to be, and do you need a plan B? And that's, you know, I think it's terrible for the world, it's terrible for the United States, but it's good for Bitcoin.
All good for Bitcoin. Now RFK recently announced that he was going to put the US budget on blockchain. I know you said earlier you're not a fan of tokenization, but you know, is there a real need for possibly tokenizing real world assets and maybe using Bitcoin as the foundation, but maybe using a scaled solution, maybe like Counterparty or something besides, you know, bloating layer one? What is your thoughts on tokenization?
I think a lot comes down to, you know, whether or not the tokenization can be decentralized. If it's not decentralized, then I'm not sure it accomplishes anything. So, you know, a blockchain isn't necessarily decentralized. It can be highly centralized. And a highly centralized blockchain is no different than the way the fiat system is. So I guess that's how I would answer it. Like, well, you know, somebody would have to prove to me that they really can do this in a decentralized way.
Yeah, yeah. Yeah, it's interesting because, you know, how are we going to get transparency and accountability? You know, like you said earlier with the miners, even, right? Like, how do we know exactly what they're doing? But even your random number generation, I was thinking of Las Vegas, you know, for a reason, like, how do we
Yeah.
know, right? Those machines, you know, well, they're audited by a government agency. Well, like, how do we know they're not in cahoots with each other, right? There's no audit trail, I don't think, on some of those machines. And so it seems that
Yeah,
that was my first
that's
use case I thought of was like the casinos. Like, how do you
yeah,
prove that the chances you say they are legitimate, right?
yeah. Yeah, that's the very basis of this product or service that we're coming out with, is that we can tell you, one, you can prove the number is random, and two, we can prove to you how the number was calculated. And it's basically using the same block system and hashing as Bitcoin, but we're applying it to a whole different application.
I love that. I love that. But anyways, guys, hey, this was fun. Bob, I'm still jealous of your Hawaiian shirt. You are a patriot, sir, and I appreciate what you're doing for the Bitcoin space. And we're just excited to see what you guys come up with and you know, the new areas you guys are able to tap into, because I believe that's going to bring a lot of prosperity back to rural cities to where they don't all have to come to these mega cities, right? People can live on the outskirts and still have access to these technologies and grow those communities for people that want to live that way. So such a cool thing. We appreciate it. Any parting remarks, guys? Julio or Bob?
No, just to thank Bob for joining us, and thank you for his insight.
Thanks so much, guys. Pleasure to be with you.
Great. All right, guys, check out CryptoQuant.com. Remember, we do have that sale going on until May 4th. Go ahead and check it out to get 50% off of our professional plans, or reach out to us if you'd like a demo on some of our more institutional grade stuff. Till then, see you guys.